Happy Wednesday, everyone. Very well welcome back to the virtual studio this time, Aurelio. Great to have you here today.
Nice being with you, Sylvan. Thanks for the invitation.
Since we last talked, it has been a while. You are the CEO at Splint Invest, an alternative investment platform. You've been building and scaling the company for more than 3 years now. I just wanted to warm up a bit. What has been your greatest startup learning so far, if any?
Whoa, plenty of learnings, obviously, but I would say the most important one is that it's better to do everything in a team than alone. I think that was the biggest learning in a nutshell.
It sounds easy, but when you want to go fast, you usually want to make the decisions alone, and then you realize to go far, as they say, you probably need a team to keep up the speed and the deliverables.
Totally.
Wonderful.
But I would also say that the quality of decision making improves if you're doing it in a team and not like on your own.
100%. And today we really want to talk about alternative investments. I'm a very big personal finance enthusiast myself, so I'm really excited about this topic. And usually when we talk about investing, we think about maybe real estate investment, of course, stock investments with ETFs, etc. Maybe in our area also startup investments. But then there's a whole sort of new asset class that we probably don't really think about, and that's alternative investments. You have prepared some slides that I'm going to show in here as well for the live stream. And I just wonder, what are these alternative investments?
Yeah, basically this is a very, very broad term, and probably if you're going to ask 10 experts, they will provide 10 different definitions. But like in our context, I would say that an alternative investment is everything which is not a stock, not a bond, not an ETF. So everything which is, I would say, difficult to get access to, highly illiquid, and with very high minimum investment, minimum ticket. So I think this is like, from my perspective, the definition of an alternative investment.
And you wrote down a few examples here. Please tell us, what are alternative investments? Some very specific hands-on examples that I have a better idea what they are.
Yeah, sure. Probably the most known one is like real estate. I think like residential properties, commercial properties, but like we can also talk about private equity funds or direct investments. We have crypto is a very, I would say, popular and known alternative investment meanwhile as well. And in our context, we are talking about like collectibles and luxury items. So goods with like physical goods, you can really like with a fundamental value, let's call it this way, like
Got
sneakers,
it.
as you can see here, art, classic cars, diamonds, handbags, Lego. You can really go crazy.
Fantastic. And now, of course, I wonder, let's say, hey, I have my ETF strategy with the stock market. Maybe I have my own company, so I'm also sort of invested in that one. Why should I even consider, or why should I even care about alternative investments? Because if you look at the numbers, it's pretty clear, right? 81% of the wealthy, or the wealthy's wealth, 81% is actually held in alternative investments. I think that's sort of the numbers if you look at them. So why is that even a relevant asset class that I should actually think about as an investor?
I think basically it all depends about your strategy, obviously, and it's always a case by case assessment you have to do. But basically, if you care about diversification and having a portfolio with many, many different products in it with different risk profiles, and sometimes also like a different correlation, considering alternative investments is always a good idea, because as you can see on the slide, like on one hand, they tend to perform pretty well in recession phases. So usually when stock markets go down, prices of art, cars, and other luxury items, they tend to stay stable. Additionally, from my perspective, a very, very big advantage of alternative investments is usually the value grows in the same speed, at least, as inflation. Basically, because all the producers and sellers, they increase the prices on the primary market due to inflation. And in the luxury segment, this works quite good. And basically, this leads to higher prices on the secondary market as well, and then appreciation of your assets. And I would say also very important, like as I mentioned, like there is a low correlation between price developments on stock markets, bond markets, and collectibles luxury items.
Got it. So it really is sort of a safety net, so to speak, to make sure that if all the other things go down, my alternative investments keep up and stay up. So not everything turns red in my portfolio at the same time.
Exact. It makes you sleep a little bit better during night.
And is that also the reason why the wealthy, the ultra wealthy, have 81% of their wealth in alternative investments? Is that the main reason to sleep better at night and not see things going down all at the same time?
I would say so. I would say it's psychologically also driven because like with stocks or cryptos, you see a value almost every minute and it changes all the time. Usually with alternative investments, you see like your entry point and then you wait and a few years later you see the exit point and hopefully the exit is higher than the entry, but there is no fluctuation or volatility in between, which can be relaxing for you as an investor, definitely.
Right. And what about the return profile? This sort of protection usually comes at the cost of maybe a bit of lower return than a broadly diversified stock ETF. How does the return profile of alternative investments look like?
It's fun. Like the return profile is as well very, very promising. Like the downside, to quickly mention that as well, is not the lower return expectations, but it's the highly illiquidity of the products. So, if
Yeah.
you need money, it's easy to liquidate your cryptos and like your ETF portfolio or your stocks. That's something you can do like almost 24/7. And usually with a very low liquidity premium. So you can sell very, very close to market value at any point in time. With alternative investments, sometimes you can't sell at all. So like you have a lock-in of 10 years. So there is nothing you can do with the money for the next 10 years. Or if you manage somehow to exit the investment, usually this goes in hand with a very, very high discount on the market value. So this is the downside. But basically the returns are very, very promising, as we can see here. You see the comparison between, it's a little bit small, but this is like the Frank Knight Luxury Investment Index, the orange one. And as you can see, it's definitely less volatile. And it has like a comparable, I would say, value development to stock in this stock index or residential properties and commercial properties.
Wonderful. And now, I try to make an example and say, hey, I'm an individual private investor. I'm not part of the ultra wealthy, but maybe I have some money on the side. So based on the lock-in period that you just described, due to the high illiquidity of these assets, I probably have to think very carefully how much of my overall portfolio that I want to invest in alternative investments, because if there's an emergency or if I need the money, I either get it out at the huge discount or not at all. What is sort of the best practice? How much should I sort of allocate into alternative investments? Probably not 81% is the ultra wealthy, but maybe still a very significant portion. What's the best practice there?
To be honest, there is no single answer to that because it always depends significantly on your risk profile, also your like liquidity needs of the next couple of years and your investment horizon, generally speaking. But I would say, from my perspective, or the rule I apply to myself is it should never exceed 20% of my total portfolio. And generally speaking, I think for a retail investor, it should be closer to 5 to 10% rather than 20% of your total wealth.
Got it. I think that's a great rule of thumb. Just feels also right in the gut to not put all the eggs in that basket. And
Totally.
we know, okay, we have to smoothen the ride. So this is a great additional different risk profile that we can add to our portfolio. But then another big challenge comes up, not the illiquidity, but actually the access to these kind of investments, right? Usually they are very privately available to ultra wealthy or to people with a very good network, or maybe even on top of that, they require quite a significant investment. We often know that from startup investing, right? Private equity in that sense, 50K or even more as a minimum ticket size. You need to make a few bets to have a diversified portfolio. So how does these entry barriers with a high ticket to these luxury items play a role in the access to this investment class?
I mean, it's a big, big barrier, obviously, for retail, as you said. Like, um, uh, usually we say that in order to build a diversified portfolio in one single category, like for example, watches or art, you need at least 250 to 500K for one category to have,
Yeah.
I would say, a decently diversified portfolio as a private individual. And obviously, you don't want to invest just in art, right? You would like to invest maybe in cars, art, and watches, maybe wine because you like it. So you need easily like 2 millions just to
Yeah.
for alternative investments, and applying it to the rule we discussed before. If that's 5 to 20% of your total wealth, I would say you're probably no longer a retail investor. But like next to
Exactly.
the minimum investment, like very, very important is, as well as we mentioned, the liquidity, obviously, but also the fact that, it's very, very hard to identify the right investment opportunities in this alternative segment. Because like I wasn't aware of that, but only 0.1% of all the wine bottles out there in the market are investment grade. So like it's really not like a no-brainer where you just go to the supermarket and say, like, I'm going to buy in a few whiskey bottles and wine bottles and the car, and that's done, and that's my alternative investment portfolio. No, it's really tricky. You have to be careful in what you're investing, and also with whom you're investing, because there is a very high intransparency in the market. And as you
Yeah.
said, often it's not publicly, so you cannot like go to a platform or like an internet website where you have a list of all the partners for alternative investments. That's something which is usually more intransparent and managed privately.
That makes a ton of sense. And I assume that's exactly where you come in with Splint Invest to make all of that easier. Please tell me how you do that. I'm just curious to see how that works.
Exactly. So this is at least what we try and what we have done very successfully, I would say, over the last 3 years. With Splint Invest, we actually built a platform dedicated for retail clients, as we are. And now you have, like, within one app, one platform, you have variety of investment opportunities in this alternative segment at the click of a button, starting with very small amounts like 50 euro. And I think the most important thing is we manage everything for you. So we take care of the collaboration with the experts. We manage this private network of partners. We select the investment opportunities. We curate them in a way that we also verify existence, valuation, the quality, the potential. And basically, everything you can see in our app is investment grade. Your job is really just to select what fits your preferences on investment horizon, volume, and category. And that's it. And we also take care of reselling the underlying product at maturity. So you don't have to also worry about exiting your investment. That's something we do as a service. But obviously, if you don't want to wait till maturity, we also offer a secondary market where you can always trade your fractional ownership with the whole Splint Invest community.
Well, that's like a lot of game changers in one product. And I want to go a bit deeper one by one. The first one is obviously from a regulatory slash actually investment perspective. How did you actually pull that off to be investable or have these splints, as you call them, from just 50 euros or 50 Swiss francs onwards? Because that's already quite a novelty, right?
Yes and no. To be honest, it's the way how we apply it. It's very innovative, but basically, the foundation is civil law in Switzerland, which is pretty old and has nothing to do with innovation, I would say. But basically, the way how we combine this in building a digital registry of ownership for luxury items with the blockchain, to really have this fractional ownership in a secured way, I think this is the innovation. Yeah.
Got it. And then the next, you first built the platform to have the legal framework to make that possible. But then the key aspect is, of course, to source and get access to good investment opportunities, to good alternative investments. How do you make that happen? Because there, I assume you have the same problem. You need a good network, you need a brand or some sort of volume to be actually interesting for partners to work with.
Totally. And in the beginning, that was like the biggest challenge. Everyone who built a marketplace or a platform knows that solving this chicken or egg problem is always difficult. In our case, I would say it was especially difficult because, every partner which is now working with us was not waiting for us to be there because they have a very solid business with high net worth individuals and family offices. So like they were not hungry. They were just like doing good business with known clients. And it took us quite a while to convince them to collaborate with us as well and to show them the potential of the retail community. But meanwhile, we have a network of a bit more than 25 experts for 13 different categories all over Europe, which helps us a lot, on one hand, to source very, very good investment opportunities, but it also creates some sort of competition between the experts, because usually family offices and high net worth individuals, they work with one expert for art. In our case, by having multiple experts for art on the platform, they compete with each other, which I would say creates more power for the retail investor community.
Nice. And how does that then work from a cash flow perspective? At one point, you need to make a decision, do we buy this piece or not? And at the same time, you also need to have the individual Splint Invest investors behind it, right? So how does that process work that you as a company, as a startup yourself, don't have a big risk on your balance sheet to hand over, but not knowing whether you actually have the transaction going through if your investors is a base or not?
So basically, it's not possible to completely get rid of that balance sheet risk, because when we source the asset and we do the due diligence on them, and then we buy them actually. So basically, it's always some sort of balance risk involved, but we managed to reduce the cash flow risk in a way that we act as a platform. So the partner gets paid once we sold the fractions on our platform. So we own the assets up front to resell them, obviously, but the bill is actually only due once the asset is sold.
Got it. And how do you ensure the quality along the process? Because at a certain point, just thinking about incentives, you might also be incentivized to say, oh, it would be better to have more volume because then you can also make more money as a platform. But at the same time, more volume would potentially, at least in the long run, also mean at least a little bit of a lower quality. How do you ensure that you always keep top quality and everything is safe?
So on one hand, I really believe that it's I would say a question of philosophy and mentality, and we always are here for the long run. So if we would provide less attractive investment opportunities today, latest in 1, 2, 3 years, this will have a negative impact on our company. So this is why we always only focus on very good assets. With the disclaimer, obviously, that there is always a market risk involved. Like, we can do the best job on earth, but there is always this potential risk of losing money by investing in such assets. On the other hand, the nice fact about the luxury item industry is that you don't have to always have more assets. Sometimes you can also just provide more expensive assets to grow. So, for example, today we focus on classic cars from the 90s, which on average costs 90 to 130,000 euro, because this is approximately the investment appetite of the community every month.
Yeah.
Let's say that in 1 year from now, we doubled the community or we tripled the community. We're not going to provide 3 cars. There are always cars in each price segment. So there are very, very interesting investment opportunities in cars, for example, with an average price of 500,000. So this, we are not forced to put too many assets on the market. We can simply scale by providing more valuable assets to the platform.
Got it. And I also want to check here what you have on the slide. Let's say you decided to buy a car, as you just described in your example. Then you hold that, or the investors that participate with their splints also hold parts or splints of that specific asset. And then something really cool that you mentioned before is the whole trading. So you bring liquidity to an illiquid market, basically. So I can then sell my splint if I wish to do so. How does that exactly work? Because that makes it almost tradable as a stock.
In theory, yes. So as you mentioned, there is this layer of the physical asset, which is the car, for example, which the car remains actually in the garage until we resell the car, which is the natural, let's say, exit event or liquidity event. And the other layer is the tokenized layer of the ownership rights, which can independently of the car be traded between users. That's correct. However, what we have noticed after 2 years of running this marketplace with trading feature is that it's not really creating liquidity as we are used to see liquidity on stock markets. It's more let's say you have an exit option in case urgently needed, but you still pay, I would say, an exit or a liquidity premium of 5, 6, 7% if you are forced to sell fast. So I wouldn't say it's liquidity, it's more like a exit option in case urgently needed.
Emergency liquidity if needed.
Emergency liquidity if needed, exactly.
Exactly. And how do you determine the price when you hold the asset? And let's say maybe it's like half a year or 1 year into the holding period, and then I decide to exit. How do you come up with that price for me to then exit in case of an emergency?
So basically, like we can say with the example of cars, like recently we invested in an Audi R8. Um, the process is very simple. Like there are a few such cars in the market.
Mhm.
We own one of them, but all the others are traded. So what we do is actually every month we check all our databases. Some of them are like publicly available, others we pay for the access, and then we actually check how many of this example or of this car were traded at which price globally. Then we take this as an indication of the new market value, which is then updated in the app for you as an investor. So you always, on a monthly basis, you know the updated market value for investment, and this is then your reference to offer your fractions to the market.
Cool. And then there's also the potential exit period, right? Where you can go and say, hey, now you decide to exit the asset. Let's say we stick to the Audi R8 car. Who actually decides when you sell this asset, when you sell this car?
There are different scenarios. Let's say the plain vanilla case is we define an investment horizon. I think in this case, it's like 5 to 7 years. So when you
Mhm.
invest, you know that we are going to hold this car for the next 5 to 7 years. It's rule based, and then we become active after 5 years, and we try to sell the car for the best possible price. However, it happens from time to time that we receive buy offers without being active on the market because like the assets are visible and people like them, so they approach us, hey, can I buy it? And if we
Mhm.
receive an offer which is above our expectations, we sell it. So it's
Yeah,
basically all about like how much return did we already generate for our investors in this time period. And if it's in line or above expectations, we sell.
got it. That makes a lot of sense. What happens if you have the time horizon, let's say 4 or 5 years, and then the market, for whatever reason, is dry and no one wants to buy the asset or only at the pretty low price? Would you still be forced to sell it, or would you sort of extend your investment horizon? What would happen in that case?
So basically, the main reason why we have this investment horizon of, let's say, 2 to 4, 4 to 6 years is to really avoid a situation where we have to sell and there is no market. Um,
Yeah,
However, if for 2 years we are not able to sell the asset at a reasonable price, we simply wait and extend the holding period um, to really maximize the return. However, after the longer investment horizon it has passed, we can accept offers below the balanced scenario. So in theory, that's the point where we also can start realizing a loss and sell it
yeah.
below the initial value, but not
Got it.
before.
Okay, got it. And of course, I'm also very curious to learn more about your business model. So, what does that cost me as an investor? Because you do a lot of work from sourcing to due diligence to also adding liquidity. And how do you, as Splint Invest, make money?
So basically, I guess it's a little bit small to see here, but like this is a screenshot on the right hand side. You see a screenshot of the cost analysis we provide for every asset. Basically, if you check this, you will see that the total asset value is composed of the value of the car. So what
Mhm.
actually we paid for it. Then you have cost for storage and insurance. This is the second layer. This is not something which stays with us. This is like paid to the storage company and the insurance company. And then we have the so-called platform fees. That's actually our revenue. That's our service fee for everything we just discussed. And this is usually between 4 and 7%, depending on the investment horizon. So for short-term investments, like 5 years, it's closer to 4 or 5%. For 10 to 12 years investment horizon, it's closer to 7%. But in
Got
any
it.
case, you can see everything in the app, and the breakdown is available on an asset level whenever you start investing. And then basically at the exit, that's when everything is going to be realized, we charge a 2% exit fee on the sales price on top.
Got it. So you also sort of participate if the markets go well and they can realize a higher price. You also, to a certain degree, not like a full performance fee, but to a certain degree, you also do participate in the value increase that you hope to achieve.
Yeah, exactly. It's not like a pure performance fee because it's a 2% of the total sales value, not on the value increase, but totally like if we sell it for 1 million rather than 500,000, 2% is more.
Perfect. And I wonder, give us a bit more of a historic overview. You started about 3-4 years ago with your company, and I would just wonder, the beginning, there was a real boom in alternative investments. I think we read in many different newspapers, watches going up, handbags going up, even wines and cars. Everything went up like crazy, also during the pandemic. And if I'm not mistaken, I'm by far not an expert, but over the past few months, there has been a little bit of a correction in some of the markets. So how were the past few months and years for you in terms of different market environments? Did you also notice any difference in terms of user activities or access to investments, etc.?
So, yeah, what you just said is very interesting because that's absolutely correct. So a few years ago, especially during COVID, I think watches were a good example of overpriced assets. Obviously, like now we learned that they were overpriced during that phase of the market. It was difficult to identify it. But basically what we see is the appetite to invest in such assets is always here. And it just shifts from watches to whiskey, to art, to sneakers. And there is always something which is en vogue, let's put it this way.
Yeah.
And what's en vogue might change, but there is always something which is interesting to invest in. Obviously, we try to, I'm not saying educate because that's a very strong word, but we try to help our investors to identify that or realize that by investing a little bit in everything independently of those like trends is probably the smartest strategy. However, like we are not like doing investment services or like recommendations, so we cannot like invest your money for you, but yeah,
Right.
that's what we recommend. Not following too much the trends, but trying to have a strategy and stick to that strategy no matter what the market is doing, if you believe this asset is going to increase in value over time.
And I like that. It again shows the importance of diversification, right? So in the end, you always have supply and demand. If there's a big supply of watches, the price drops. And then the demand might shift to paintings or whatever, and then the prices surge there. So it really is important that you as a platform have different kinds of alternative investments to also accommodate for the shift in that regard.
Totally. That's also the reason why we focus on really small tickets like 50 euro. Not because the average investment per user per month is 50 euro, but because like with, let's say, 200 euro, you can invest in 4 different assets every month and build a well-diversified portfolio.
Got it. Do you also have, I'm not sure if you publicly talk about that, but do you also have any KPIs that you can share, where your company is today and maybe the returns that you realized for your investors on average or something like that?
Yeah, sure. Basically, like it's very difficult to build an average so far because we only had like 3 communicated exits and 2 additional exits, which were just happening this week, so 5 in
Oh,
total.
nice.
But
Congrats.
yeah, not yet officially communicated, but yeah, very, very happy about that. And I would say like the, let's say, lowest return on investment, and it's always net, was 15% plus in 3 months. That was really a lucky punch because we purchased the asset really below market price and received a very competitive offer to resell very, very quickly. And
Nice.
the most promising exit was a plus of 64% in 1.5 years. So yeah, obviously we only sell if we can like realize a very good net return on investment for our investors. If not, we wait. But that's the range of profits we made with our assets over the last 12 months.
Amazing. Super interesting. Thank you for sharing that. And of course, I'm also very curious, how does your own Aurelio's portfolio look like? Can you give us a sneak peek behind your portfolio?
Yeah, totally. I'm a very I would say boring investor. I really believe in diversification through very liquid assets like ETFs. And there I really try to minimize costs. Like there are very, very good solutions out there in Switzerland, like Findependent, for example, where you can invest easily in ETFs at reasonable costs. So that's my main pillar, let's put it this way. And then obviously like a little bit of real estate, alternative investments, and I have some sort of risk concentration in private equity with a Splint Invest, obviously. So that's also part of the portfolio. But I would say the main focus is really highly liquid, diversified ETFs, and then adding some spice to my portfolio with things I like.
Fantastic. And nice plug for Findependent. They're actually going live with a podcast with us at Swisspreneur tomorrow. So the episode will be live with them. Perfect plug.
Perfect timing.
And in your splints, what are the splints that you invest in? Like you invest in pretty much everything, or you have any preference in terms of cars, whiskeys, arts, watches? What is sort of your biggest allocation in that regard?
Um, I try to buy a splint of everything, a very simple strategy whenever there is a new asset, 50 euro. But I have a strong preference for whiskey casks, actually, because we started with whiskey casks and I'm rather risk averse, and whiskey casks have a very solid performance. You cannot triple your money in a few years, but it's like a bond where you have your yield every year, and that's what I like. So that's why I have a slightly preference on whiskey cask, but I really try to invest at least one splint in almost every asset.
And walking the talk, I think that's also very important as a founder to invest and sort of eat your own dog food, as we like to say, right?
Yeah, totally. And especially because to be honest, we built Splint Invest for us. So, and I'm probably the biggest fan of the application, also like the features and everything. Now we start realizing that we should bring in some additional perspective to optimize the product, not only for us, but for everyone. But in the beginning, it was really heavily influenced by us being the best users.
Very good. That's the perfect starting point to build something that people want. Now, I have one last question for you before we switch over to some rapid fire questions. If anyone is now interested to learn more about this whole topic of alternative investing, or also to actually, give Splint Invest a try, where should they go? Where can they learn more?
Sure. I mean, there is a lot of information in the app itself. So we have a blog section where you can read about categories, about individual assets, strategies, risks. So the app itself is a good source of information. And then I would definitely recommend checking out our YouTube channel, but also other YouTube channels of our experts, and LinkedIn. LinkedIn is as well a good, I would say, a platform to stay up to date. And then doing research on your own on the internet. I think that's very important as well, to get an independent opinion about the categories and the market, not rely only on our information, but have an own source of information and opinion. And obviously,
Absolutely.
if people would like to test the app, we always offer this risk-free possibility to get started, to explore the processes, to see how it works, simply by downloading the app. And in your case, you can offer this Swisspreneur community the code Swisspreneur, as you can see it here, and then they will get 100 euro to start, which means they can actually buy 2 splints on us to really experience the app, see how it works, read the information, and then test it.
That's a pretty compelling offer. Thank you for sharing that. Now, to
Yeah,
wrap things up, I also want to ask you some rapid fire questions. I think the first one that I planned to ask you already sort of answered, but maybe there's a different one too. What's your favorite alternative investment? If you say whiskey, I want to know the second most favorite.
So yeah, the most favorite one is actually Japanese whiskey casks, I would say.
Nice.
And the second category is cars. I mean, I'm a huge Formula One fan, so I have some sort of emotions related to Ferrari.
Nice. So that's your team. Which driver you support of Ferrari?
Basically, I'm supporting the team, but yeah, currently I'm more in Team Leclerc than Team Sainz.
Perfect. Are you more of a morning person or a night owl?
morning person, definitely.
And what is the best piece of advice that you have ever received?
Generally speaking, I would say go big or go home.
Yeah, that's especially true for Swiss mindsets. I think that's a good recommendation. And what is the biggest investment mistake that you have made?
Oh, I once wanted to build a strong seltzer company in Switzerland. That was a big investment mistake.
Fair. And if you had to
But a lot of
summarize in
learnings.
one word, what is the key to startup success?
Ooh. Uh, I go for persistence. Persistence.
Yeah. As with investing, everything compounds, right? So if you are persistent enough, hopefully you chase that compounding effect no matter what you're doing.
Exactly.
Aurelio, that was a lot of fun. Thank you for showing us the world of alternative investments. I'm sure it was not the last time that you were with us on the show or the podcast or anything. And best of luck, lots of success, and until the next time, I would say.
Yeah, thanks a lot and see you soon, Sylvan.
Thank you.